afternoon. Welcome to the latest episode of Gold Sessions. It is an honor and privilege to have Von Greyerz advisor come onto the show to talk about gold, commodities, the super cycle, and where we're going to go from here and some of your experiences. There are basically, Ronnie, three subject areas that I want to cover with you today. One, what evidence would you draw on to suggest that we are genuinely in a commodities super cycle? And how should we think about that over the next 5 to 10 years? Secondly, I want to move on to a bit of your history and experience. You've been so ahead of the curve, Ronnie, on gold for such a long time and have been advocating precious metals mining stocks as well as physical gold for some time. And it's been quite a lonely place, particularly in the mining stocks. But now you're having your time in the sun. I'd love to get your perspective on how early we are into that. And thirdly, very simply, inflation adjust gold and silver. How do you get to your target prices for those two metals? So let's just kick off with the first point on the commodities super cycle. What evidence do you think our listeners should be pointing to suggest that we are genuinely in a commodities super cycle now, if you think we are?
So hi, Jonny. It's a great pleasure. Thanks for having me, and thanks for still having me as an advisor to Von Greyerz. It's a true honor and pleasure. Well, I think the term super cycle is always a little bit misleading because commodities aren't an easy asset class. However, I think if we discuss like the primary drivers, I see a couple of things. First of all, we saw a major bear market in underinvestment, the so-called capex cycle. So, commodities boomed basically around 2011, 2012. And since then, we've seen that all the investments in infrastructure, in energy, in mining have been structurally depressed. And now we're kind of seeing, more demand for, let's call it stuff, copper for grids, silver for photovoltaics, for the solar industry, uranium, obviously, for the massive base load needed. Everybody's talking about AI, but very few people talk about the enormous amount of additional power that we need, rare earth for everything with a battery. So, we cannot run a green transition on PowerPoint slide and just ESG brochures. We need mines, we need wells, we need commodities. And I think that a major driver also for this capex cycle has obviously been ESG. Everything that was related to commodities was basically kicked out of portfolios. I think that most institutional asset managers were kind of scared to hold any assets in the commodity space. Then we're seeing, another important driver, which is obviously supply deficits. We're seeing it in the silver space, for example, 5 years in a row with structural deficits. We're seeing in the rare earth space, or as it's also called, critical mineral space, we're seeing that the production, but also the refineries, that's heavily focused on or heavily centered in China and a couple of other countries, and that's something that cannot be solved within the near future. Then we're seeing very, very low valuations in the commodity space. So actually, if you compare the valuations in the resource space to other sectors in the S&P 500, for example, I'm seeing very, very compelling, very depressed and very contrarian valuations at the moment. And then I think we're seeing some sort of a regime change in the world of macro. We're seeing that this fiscal dominance is becoming more and more important. We're seeing that actually inflation, will obviously stay around the corner. ECB, but also the Federal Reserve, if they would still adhere to the 2% inflation target, they wouldn't have been in a position to actually lower rates. So I think that we're now, nobody's really talking about that, but definitely the inflation let's say regime has probably changed has been changed by central banks. And then another major driver is obviously the fact that commodities are now less and less dependent on the common supply demand criteria, and more by, I think, political pressure. So the fact that I just came back from two big conferences in Zurich, and I can tell you from all the one-on-one meetings that I had, all the companies that are in the resource space, they are now telling me that they're being contacted by various departments, by the U.S. government officials. They're being offered financings, offtake agreements, support when it comes to permitting. What did take like 3 years previously now can happen within just 3 months. So I think very late, but finally the US is waking up to the fact that they're heavily dependent on resources, and I think that this resource nationalism will stay around the corner. So if you combine those structural drivers with an outlook for perhaps a major bear market in the US dollar, this is something that we're seeing, and this is something that the Trump administration actually actively pursues. Then a very negative, let's say, a positioning, a very contrarian sentiment, then I think that's a pretty good setup for the commodity space.
Yeah, and so you've just got a complete mismatch, haven't you, between ownership of the asset class versus the structural drivers and the change that we are seeing at the macro level and bottom up, to suggest that we're moving from an environment of the last 20 years of financial assets, but all the signs are there that we're going to be moving to an environment for the next 10, 20 years of hard assets, which is very clear to me. Most wealth managers, portfolio managers are simply not positioned for. So funnily enough, I've just come back from a big conference in Asia, and it was very, very clear there that with debt and inflation that are going to be omnipresent for the next, certainly the foreseeable future, and that requires an entirely different portfolio, which will benefit commodities from the sort of software, tech, and US dominated portfolios that most people have today. Because let's face it, there's a generation of fund managers today that haven't really understood what it is to manage money in an inflationary environment.
Absolutely. So I always say that the best when I'm presenting abroad, and I made my keynotes I think in 35 or 40 different countries all over the globe, and the best questions after my presentations are always asked in countries like Turkey, for example. Why? Because they know how to
they've seen it
to treat gold, and they know that actually having a proper view on inflation is like essential for your portfolio construction. So for them, it's just portfolio protection against inflation is something natural. That's actually the starting point. While we in the Western world, we think that we're going back to the old inflation regime, the great moderation. But I think that's pretty naive. And actually, I think that 2026 could be a year where we'll really see the next leg higher in inflation. So the next inflation wave might already be building up.
Well, we're going to come on to sort of the outlook a bit more, and inflation, sort of try to inflation adjust what we think gold and silver in particular are going to go to. But I just want to, on the second subject area, I want to touch on, Ronnie, sort of your perspective of having been in this space for such a long time and having been ahead of the curve on gold when no one wanted to know, but now it's all of a sudden at $4,000. It's sort of making a few headlines, and I just want to understand What's it been like for you as a participant for many years in the precious metals sector when no one wanted to know, but now all of a sudden it's coming right? How does that feel?
A great question. I mean, it's not been easy. As you might perhaps not know, Johnny, I'm only 25 years old. So, so the last couple of years covering the mining space and gold, they've been pretty tough. No, just kidding. I think, being ahead of the curve sounds great, but if you're early in the market and too early for your calls, and then actually running investment funds, that's not always easy. But thank God we've got terrific investors that really believe in our core thesis and that believe that we're now in a structural and secular bull market for gold. Now, let's face it. I mean, gold is not a contrarian asset anymore. We had that in 2019, 2020, probably, 2022, I think the Wall Street Journal came out very close to the lows with an article about this, gold being a pet rock and completely useless. We're not in that stage of the bull market anymore. This first phase, according to the Dow theory, the accumulation phase. Now we're in this, what the Dow theory calls the public participation phase. So now if you go to a cocktail party and say, well, I like gold, I like silver, people will say, yeah, Ronnie, I always said, you have to own some gold. While, previously they would have said, Ronnie, crazy, gold is a pet rock, it doesn't pay any interest. So we're now in this stage of the cycle, which, the public participation phase is by far the longest phase of this bull market. This is basically the meat of the trend. And we can also see that, the media is picking up the topic again. I'm being interviewed by national TV stations. There's like mainstream investors magazines now getting interested in gold and also mining stocks. More and more people get interested in the topic of silver. So and then also, I think it was pretty interesting that quite recently Jamie Dimon, who doesn't have too much love for gold, actually, he came out saying, gold could easily go to 5 or even 10,000 US dollars. Morgan Stanley, I mean, Johnny, we came out with the new 60/40 portfolio in our 2024 in gold we trust report, and said, in this in this cycle where inflation will be pretty stubborn, and where we see high inflation stability, the old 60/40 portfolio doesn't work anymore. So you have to rethink your strategic allocation. And we introduced a new 60/40 portfolio. Now, recently, a company that is still slightly larger than Incrementum, Morgan Stanley, came out and they were proposing the 60/20/20 portfolio with 60% equities, 20% bonds, and 20% gold, actually. So this is a sign that we're now further in this bull market, but I don't think that we've seen the mania stage yet. Yeah, the crazy stage where if you go back to that cocktail party, you say, I like gold, people say, no, you have to buy, silver junior explorers, and you have to take out the mortgage on your house, basically, and only invest in private placements to buy into those junior mining stories. So we're not there yet. I think we've got a couple of good years ahead in the cycle. And I think now is, and this is what we described in this year's In Gold We Trust report, I think in the first half of a bull market, it's actually gold leading the way. And in the second stage of a bull market, it's silver and also the mining stocks outperforming gold. And this is also the time when actually commodities start outperforming gold. And I think this is really where we'll see probably the best risk reward ratio over the next couple of years.
Well, it's interesting you'd mentioned Morgan Stanley. Of course, I worked there for 23 years before joining von Greyerz, and I've just been in Asia with Mike Wilson the strategist who made the point, and we were both panelists on discussing this very issue last week in Singapore. And of course, he was just saying, look, the world has changed, and that in a world of over indebtedness and inflation, you have to protect your portfolios against this, and gold clearly is top of the pops in terms of an asset class to help investors do that. But the reality is, I saw some research done. I think it was by Jim Luke, who runs the gold fund at Schroders, and he was saying that, of course, if you actually try to allocate, if you take all the wealth management portfolios around the world and you took 20% out of bonds and you put 20% into gold, then it would require 19 years of annual gold mine supply to be able to satisfy that incremental demand, which of course is totally possible. It's something like $12.5 trillion. So, but just getting to 1%, let alone 20, will just cause a massive increase in the gold price, because there simply isn't the supply there. So yeah, look, we're very much on side with that. Look, just in the interest of time, because I want to keep this short and snappy, let's do that classic sort of fund manager target price game. Egon von Greyerz stopped giving target prices many, many years ago, but I know you've done some pretty scientific, detailed research on inflation adjusting where gold can get to, where silver can get to, which looks incredibly cheap versus gold. Can you just talk us through how you sort of get to your target prices for both gold and silver?
Yeah, well, in 2020, we put out a report saying that the 2020s will be a golden decade. So we said back then, when gold was really contrarian, we said that at the end of this decade, our base case scenario, based on our proprietary monetary model, and I think it's very, very important to value gold as a monetary asset and not as a commodity. But based on that model, we're seeing $4,800 by the end of this decade, so in 2030. And people said, you're out of your minds. That's impossible. It's not going to happen. Now people say, well, okay, sounds pretty conservative. So back then we also said, if inflation will be a major topic in this decade, we said this is highly likely. Then actually in such a high inflation, or let's also say loss of trust scenario, $8,900 is possible. And we're actually right on track of this inflationary price target. So if we continue on that path, we'll exactly reach 8,900 by the end of this decade. Now, 8,900 sounds still like a very, very optimistic number. That's a CAGR of 16% from now until the year 2030. So I think, with gold being up 55% year to date, I think this is definitely possible. So, I think, therefore, gold is, as I've mentioned, in a bull market. We're in a stage where more and more institutional players wake up. And I think it's important to emphasize that this bull market is primarily being driven by physical demand from emerging markets. Now, very, very late, Western financial investors actually joined the party. And if we have a look at ETFs, and I think that's a pretty good proxy for demand, for financial demand from Western market participants, we can see that there's more and more money flowing into the gold. However, since the year 2020, it has only been like 100 billion. So I think, if you compare that to other asset classes, it's still not a huge number. That's like 2% of the current market cap of Nvidia. So I think there's still room to go for Western financial investors, especially as you rightly said, if there should be, a reallocation of capital from the fixed income side, which is currently like 160 trillion. And more people will realize, well, actually, we have to diversify and, diversify into the most reliable inflation hedge, probably makes the most sense. So that's it for gold. If we have a look at silver, Silver is not only on an absolute basis, now trading at the same levels like in 2011 and 1980, but on a relative basis, I think silver is extremely cheap with the gold-silver ratio still above 80, above 80. So, the long-term median is around 50. So the median since the year 1900 is around 50. And what we usually see at the end of a big bull market for gold is that the gold-silver ratio, spikes to new lows. So can we see a gold-silver ratio at 15 or 20? Yes, definitely. So I think what's missing for the perfect storm in silver is actually investors' demand. We've seen, some modest demand coming in for silver, and I think at some point many asset allocators will say, well, gold is doing well, but we need a little bit more leverage on gold. Actually, we need something that is cheaper on a relative basis, and if some capital flows into the tiny silver market, I think that's really going to cause a major bull market, and I think that triple-digit silver is definitely in the card. So, we try to value gold from based on our monetary models. We've described how we came up with the reasoning and the factors and the scenarios that we're using in our 2020 report, and since then we update the numbers every year, and I think we're right on track. However, having worked in a bank for quite a while, I know that models sometimes do not work, especially if they're extremely complex. So we said, okay, let's really keep it simple and analyze what's the most important driver for gold. And it's actually growth of M2, or the growth momentum of the M2 monetary aggregate. So we kept it pretty simple, and I think it's keep it simple, stupid, and so far the model works perfectly well.
Fantastic. Well, listen, Ronnie, we're coming to the end of time now, and I just want to sort of summarize the key conclusions, if I may. As far as the super cycle is concerned, there are any number of macro drivers that would suggest that the bull market in commodities is really only just beginning and can have some very, very serious legs over the next 5 to 10 years. That we are moving from a period of investors just used to investing in financial assets, and they're going to have to get used to investing in hard assets to protect them from ongoing currency debasement and inflation. And as far as gold and silver are concerned, you've been very, very early onto this and very accurate with your forecasting. If we follow the current path of inflation, we could easily hit 8,000, 8,900, I think you said 9,000 with gold, and with silver, certainly triple digits, given how much it's lagged on any historical metric versus gold. Is that a fair summary?
Absolutely.
Perfect. Ronnie, thank you so much for taking the time. We're up at 25 minutes. Thank you for being a wonderful advisor to von Greyerz, and let's do this again sometime. Thank you very much, Jonny. I really enjoyed it. We have to come up with a good name, like Jonny and Ronnie discuss money.